Welcome to vTalkInsight, Allocator's Lens Daily for March 31st, 2026. The cross-asset picture today is dominated by an energy shock colliding with already elevated valuations and volatile bond markets. Equities are working through a multi-week correction. The volatility index is back above 30, and oil prices near triple digits are feeding new inflation worries, even as growth signals stay mixed. With that backdrop, let us start with equities, where earnings resilience is now being weighed against rising macro and geopolitical risks. In equities, the dominant story is a valuation reset under pressure from geopolitics and higher real yields. The S&P 500 has logged 5 straight weeks of losses, its longest losing streak since 2022, and volatility has pushed above 30, confirming what options data already hinted at. Positioning is cautious, not complacent. Forward price to earnings ratios have fallen from around 28 times to roughly 21 times, an 18% compression, yet they still sit above the historical average near 18.5 times, so there is room for further derating if the macro shock deepens. Hedging activity has picked up, and many allocators appear reluctant to embrace a full by-the-dip stance while the energy and geopolitical backdrop remains unresolved. Against that, the fundamental picture is not uniformly bleak. S&P earnings are still being revised higher, with mega-cap technology companies delivering robust profit growth and driving much of the index-level expansion. Despite this, recent market gains have become increasingly concentrated in a handful of large technology names, and the latest pullback has exposed that concentration risk, with major platforms such as Meta suffering double-digit single-day declines. Even so, some large banks have raised their S&P targets on the back of improving earnings momentum, and there are projections that the index could still make new highs by year-end if the macro shock remains manageable. Put differently, multiples have compressed by about 17% while earnings are rising, so the correction so far has been more about risk premia than profit deterioration. Leadership beneath the index continues to rotate. Energy and refiners have posted double-digit gains this month as Brent crude has surged about 60%, with refiners up roughly 24% for March, and oil majors like Exxon, Chevron, and Occidental strongly outperforming. At the same time, big tech valuations have already fallen from about 31 times to around 23 times earnings, and capital expenditure plans are set to rise 30 to 40% by 2026, raising questions about whether the sector is becoming structurally more capital intensive. That combination of higher spending and still elevated multiples has sharpened worries about capital misallocation and the likelihood of clear winners and losers in the next technology cycle. Company-specific moves, such as Cisco broadening its exposure with a cash and carry acquisition and Expedia being rewarded for limited geopolitical exposure, underline how sector and business model differentiation is becoming more important. Looking ahead, the equity narrative is being set by the interaction between the energy shock, growth, and rates. If oil stays well above $100, the benefits to energy and materials could be offset by pressure on consumer staples and discretionary spending, especially as gasoline prices rise and real incomes come under strain. Scenario work suggests that a move in the 10-year Treasury yield back towards 5% would create additional headwinds for valuations and could deepen the correction, particularly for longer-duration growth names. On the other hand, a still resilient labor market, improving regional manufacturing surveys, and ongoing earnings upgrades support the case that equities may be closer to the later stages of this drawdown than the beginning. For allocators, the key watch points are the path of oil prices, the shape of the yield curve, and whether earnings strength broadens beyond a narrow group of large technology and energy stocks. Those same forces are now playing out directly in global rates markets. Rates are sitting at the junction of inflation anxiety, growth fears, and safe haven demand. Bond markets have just come through 5 consecutive weeks of losses, their worst streak since 2022, as investors priced out near-term Federal Reserve cuts and focused on the prospect of prolonged conflict and higher risk premia. Global yields are near multi-year highs, with U.S. 10-year yields back around levels last seen last summer, and peers in the United Kingdom and Japan testing levels not seen since the 2000s and 1990s respectively. More recently, however, 2-year and 10-year Treasury yields have dipped for a couple of sessions as safe haven flows resurfaced alongside mounting growth concerns, highlighting just how two-way rates markets have become. The policy backdrop tilts toward higher for longer. CPI inflation has accelerated from about 2% to 2.8% year over year, and oil-driven price pressures are increasingly being priced into the front end of the curve. The Federal Reserve is widely expected to keep rates on hold, with the bar for renewed hikes described as high, but markets have largely unwound expectations for imminent easing. The yield curve has flattened as that shift has played out, with inversion risk returning if geopolitical tensions and energy shocks persist. At the long end, real yields have been doing most of the work, reflecting doubts about the Fed's ability to fully contain inflation alongside concerns over rising fiscal deficits and a prospective $200 billion fiscal package that blends defense, spending, and domestic support. Outside the United States, several European central banks look inclined to prioritize inflation control over growth, reinforcing the message that global monetary easing is less likely than it appeared a few months ago. Some major Wall Street firms argue that long-term inflation risks may be overstated and that current yield levels present an opportunity, while others stress that repeat energy shocks and wider fiscal deficits argue for more caution. For multi-asset portfolios, this means sovereign bonds are still a source of ballast in acute risk-off episodes, but their diversification properties are less reliable than in past cycles. Allocators are watching auction demand, the behavior of real yields, and the evolution of the curve closely, because stress in rates has a direct transmission into credit markets. Credit is where higher yields and the energy shock meet the real economy. Higher funding costs, record primary issuance earlier in the year, and persistent volatility in government bonds are tightening financial conditions for both corporates and sovereigns. Emerging market local currency bonds are under particular pressure as they face direct hits from higher energy import bills and a stronger U.S. dollar, forcing many central banks to tighten policy just as last year's outperformance story was gaining traction. Within private credit, earlier signs of redemption caps and gating risk are intersecting with these macro headwinds, even though core middle market lending has so far remained relatively resilient. The sector impact is highly asymmetric. Energy producers and refiners benefit from stronger cash flows at current oil prices, which supports their credit profiles, while energy importing corporates and governments face shrinking margins and rising rollover risk. If oil supply losses persist and demand destruction similar in scale to the 2020 shock is required to rebalance the market, weaker high-yield borrowers and commodity-sensitive emerging markets could see a more pronounced widening in spreads. For now, the key signals to monitor are refinancing volumes, default trends, and any spillover from sovereign stress into corporate balance sheets, especially in regions most exposed to the Middle East energy complex. These same global imbalances are also clearly visible in foreign exchange markets. Foreign exchange is increasingly defined by renewed U.S. dollar strength. The dollar has reasserted itself as the dominant safe haven as traditional hedges like long-duration bonds and even gold have underperformed during this conflict-driven shock. One central scenario sees the dollar appreciating further against the euro, with some expecting levels around 1.12 and even downside risk toward 1.10 if trade and energy disruptions extend into the second half of the year. That move would tighten global financial conditions, particularly for borrowers with significant dollar liabilities. Emerging market currencies are caught between this stronger dollar backdrop and direct energy and trade shocks. Local bond markets are already feeling the strain as policymakers raise rates or defend currencies, undermining the more benign narrative that prevailed last year. Looking further out, if disruptions in key shipping lanes such as the Red Sea and the Strait of Hormuz persist into year-end, analysts flag the risk of more structural shifts in global trade routes and even payment systems, with potential winners and losers across the currency complex. For allocators, the dollar path, euro-dollar levels, and signs of stress in high-beta emerging currencies are important barometers of how far this shock is propagating. The source of much of that stress remains the commodity complex, especially oil. Commodities, and oil in particular, sit at the fulcrum of the current macro regime. Geopolitical tensions involving Iran, ongoing conflict in the Red Sea, and repeated threats to close or disrupt flows through the Strait of Hormuz are creating profound uncertainty around physical supply. Estimates suggest that between 2 million and, in a worst case, as much as 15 million barrels per day of crude could be at risk if infrastructure were seriously damaged, while the current supply deficit is already put near 12 million barrels per day. Strategic Petroleum Reserve releases are only marginally offsetting that gap, and official reassurances about increased tanker flows appear largely symbolic. Against this backdrop, Brent has surged above $115 and is up roughly 60% this month, its largest monthly rally on record, with some forecasts now pointing toward $125 to $150 if disruptions escalate. The real economy impact is becoming more visible. Energy rationing and physical shortages are beginning to affect Asian manufacturing economies, suggesting that the negative growth effects of this shock may still be underappreciated. If supply losses persist, some analysts argue that demand destruction on a scale similar to the 2020 COVID shock may be needed to rebalance the market, which would imply a much sharper global slowdown. In the meantime, oil majors and refiners are clear winners, with double-digit equity gains, while high fuel costs are squeezing consumers and raising headline inflation. Lawmakers appear reluctant to act decisively until gasoline prices push toward $5 per gallon, though a $200 billion fiscal package blending defense, spending, and targeted support, potentially including a federal gas tax suspension, is being discussed. Monetary policy offers limited relief here. With the Fed on pause, rate hikes are not seen as an effective response to a supply-driven energy shock, yet persistent high prices still risk unanchoring inflation expectations. Gold, typically a go-to hedge during geopolitical crises, has not provided its usual protection this time. Prices have faced technical selling and liquidation as markets have shifted from expecting quick rate cuts to debating the possibility of renewed hikes, while a stronger dollar has added further pressure. Central bank demand is also cooling, with some, such as Turkey, engaging in meaningful sales, and there are concerns that larger buyers could move toward more active management of their holdings. All of this has weighed on bullion, contributing to a sense that many of the traditional hedging relationships are less reliable in this cycle, which in turn pushes more of the inflation and risk premium burden onto energy and industrial commodities. Industrial metals round out the picture with a mix of risk and opportunity. Aluminum prices have surged on concerns over Middle Eastern production, which accounts for a meaningful share of global supply, and on new taxes targeting producers in that region, propelling aluminum producers to sharp single-day gains. Those price spikes have partially retraced as global growth worries and potential demand destruction reassert themselves, but they underline how sensitive supply chains are to targeted attacks on infrastructure. Copper tells a slightly different story. Chinese inventories are falling faster than usual and physical premiums are rising, pointing to opportunistic buying and the potential for a restocking cycle if supply chain vulnerabilities persist. Physical delivery issues in parts of Asia, including South Korea, further highlight the gap between futures and spot markets across the commodity complex. Taken together, oil, gold, and base metals are sending a clear message that inflation and growth risks are pulling in opposite directions, leaving allocators to navigate a regime where energy, rather than traditional financial hedges, is setting the tone. Stepping back across assets, the organizing theme remains an energy-driven shock colliding with an already mature cycle. Equities are digesting compressed valuations, narrow leadership, and rising macro uncertainty even as earnings stay broadly resilient. Rates are oscillating between higher for longer inflation worries and safe haven bids, with a yield curve and real yields crucial for how far equity multiples can stretch. Credit sits in the middle, absorbing tighter financial conditions and higher default risk at the margin, particularly in commodity-sensitive emerging markets. In foreign exchange, a firmer dollar is amplifying these pressures and exporting tighter conditions abroad, while in commodities, oil is carrying most of the risk premium, gold is underperforming as a hedge, and industrial metals are flagging both supply stress and cyclical fragility. For allocators, the key watch points now are the trajectory of Middle East tensions and shipping disruptions, incoming inflation and growth data, and whether earnings breadth improves beyond energy and mega-cap technology. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.